Dan, that little prompt we just has us good, right, on YouTube?
Yep, we should be live now.
Okay, all right. Madam Chair.
Okay, great. I call the meeting to order. Um,
Yes, Lori Martin,
Present.
thank you.
I think I'm kicking it over to Mike to go over the fiduciary governance calendar to start.
Okay.
And Mike, you can share your packet, yes, slides.
Just bear with me 1 second here. Okay. Can you see that okay?
Yes.
Okay. So I will touch on the governance side first before we flip into the portfolio. So this quarter, we look at some trends just across nonprofits, specifically higher ed in general, and then dig into spending policies a little bit. So just on this page, as a reminder, right, because this is not a traditional endowment, there's no set spending policy, but generally the rules, quote unquote, or a thought process behind how to spend out of these two pools are outlined here. So the short-term pool, immediate liquidity, while trying to maximize what income we can from it. The long-term pool, much more long-term orientation, but with the expectation of not regular draws, but that the ability to take a draw from the pool, if and when needed for certain projects on campus. So that, I think those have stayed the same, since we got involved close to 10 years ago, and I have been able to facilitate each of those on a go-forward basis. Just to level set a couple of trends in the industry. We won't spend a ton of time on this, but we look at independent schools, colleges, and universities, private and community foundations, and generally the spending rates have stayed pretty consistent. Most colleges are spending, somewhere in this is effective spending rate. So this has to do with, it fluctuates a little bit based on the beginning portfolio value, but on the whole, most have shifted their spending policies to between 4 and 4.5%. And the reason for that is that's what the math has proven out to be sustainable longer term, in terms of taking a draw, offsetting inflation, offsetting expenses, and then providing a little bit of growth to maintain purchasing power over time. So that number has been pretty consistent over time, and that certainly didn't change last year. A couple other just trends that we've seen in the marketplace, again, on average, about a 4.8% moving average spending policy. About 20%, so 1 in 5 institutions did make special appropriations from their portfolios last year to facilitate a whole number of projects. That number is down a little bit from where it was in COVID, which you might expect, but still maybe a little bit higher as continue to see many of your peers in challenging operating conditions, and that certainly that theme hasn't changed in COVID or coming out of COVID, just given some of the demand and inflation levels and a whole host of factors. So one thing to point out there, on average, just shy of 11% of college operating budgets funded by their endowment. That number can be skewed a little bit. Some of the largest pools out there are funding a kind of a vast majority of the operating budget for some institutions. Well, kind of on par, that 10% or less is a lot more common for smaller private organizations. And then lastly, giving was down a little bit by about 10% last year. So on the development side of things continues to be a little bit of a challenge, particularly just raising kind of unrestricted assets for the endowment, not aligned with the capital campaign, has been a bit of a headwind. Any other trends that are here? Nothing dramatic. Asset allocation decisions weren't, notably changed year over year. Looking at the NACUBO benchmarking survey, ESG, kind of the trend and theme toward ESG tilts in portfolio has kind of appeared to take a little bit of a pause. I think the conversations by many institutions have happened about kind of if this makes sense for the mission and implementing it in the portfolios, and many have chosen not to do that, in fact, and kind of taken different strides more on campus. The trend toward outsourced CIO, like we work with you all, continues to be a very positive one in the industry. About just shy of 50% of all respondents have moved to an OCIO model. that number's grown pretty consistently over time. So I wouldn't say anything overly earth-shattering from some of the trends that are out there, but I think interesting to see what the special appropriation numbers are and a couple of these points on, just ESG policy and what peers are doing in general. So I'll pause there and see if there's any questions on that piece.
I know there was a push to for transparency of investment management for some of the statistics on DEI. Has that got any traction, or has it really just died down?
So we build that into our annual kind of due diligence process across all the managers, Lori, ones we allocate to and ones we don't, just asking kind of what their statistics are, what their policies are, and then kind of tracking that year over year. We have some clients that ask to see that information. Most don't. We do see a little bit of a push from clients saying, listen, if we have to do a manager search, we'd love to include, managers that aren't that are minority owned or managed as at least one of the options in that circumstance. So we do see that push from time to time. It can be a little bit of a challenge in all the asset classes to implement there, just because there's not a huge number with kind of sustainable track records and meeting a lot of the metrics. But I would say we're starting to see a little bit more of a positive push from that trend, but it has not been dramatic.
Okay. I guess my other question is, do you know of any community colleges that have a spending policy, that have enough assets to have a spending policy like a private university?
Not on their kind of the university's assets themselves. Most public institutions will have a private foundation that support it as well, which will have a spending policy and do some of that fundraising. So we work with Worcester State. They have a foundation. We're doing some work right now or in conversations with actually Mass Art, which is a similar organization. They have both university assets and a foundation. But in terms of the university proper's assets, in terms of having a spending policy, it's not anything formal. Doesn't mean that some won't have something in place to help guide if they're going to use it to help on the operating side rather than kind of a rainy day fund or one-off projects, but it's not a formal policy.
And Lori, just so I'm clear, part of that policy is a percentage of use. Is that sometimes how you would envision this? Is this a version of how you would envision that?
Yeah, I mean, I think it's like a 16-quarter average of asset value, and take, percentage of that and then just give it to operations. I know, like you said, Mike, I think like Smith, 25%, maybe Harvard is probably higher, supports their operations, right?
Yep.
And I just, again, for context, Lori, this is in some ways why we weaned ourselves off of any contribution, right? When we were essentially budgeting with trustees, is really not treating any of this as a revenue source.
Right. Yeah. That's why I was wondering if any community colleges have amassed enough to actually have a spending policy.
Yeah, I mean, anecdotally, the closest that I would hear, and it's hard to sometimes wade through this, is Holyoke Community College has, I think, for a number of years, relied on some revenue support from their foundation.
Okay.
We always can make the ask whether it's real clear that way. I just don't anticipate that it would be governed by formal policy either.
Okay.
Okay. Anything else on the governance piece?
Nope.
All right. We will flip it over to the portfolio. So this page is it's been the same key themes in the market really for the last 18 months, but we're starting to see some of these come to fruition. The first and foremost being Fed policy, right? So where inflation is and when the Fed is ultimately going to cut interest rates. They did that in September. They did it again today, actually another 25 basis points. So the market generally saw that as a positive indication. Equity markets and fixed income markets really rallied off that. We saw the majority of the curve shift down pretty notably when the Fed cut rates the first time. Since that time, rates have actually crept up. So even though the Fed has continued to shift rates down, the belly and long end of the yield curve has actually shifted back up to where we started, June essentially. And after the election yesterday, we saw the 10-year actually eclipse 4.4% after being down below 4 for some time. So rate volatility has remained. But generally, just a couple of things on this page, right? We're in a Fed cutting cycle. The chart in the upper right just goes to show how different they can be, both in terms of, depth of the cuts and length of the cycle. So hard to predict what this one will look like, maybe a little shallower than most.
Mm.
We're not starting from, super high base rate levels. But, nonetheless, in the bottom left-hand corner, we also look at market conditions. And on the whole, for the trailing 12 months after the Fed starts a cutting cycle, it's been a decently attractive opportunity set. The other kind of key trend on this page, and we're through it now, but volatility around the elections, that tends to be a short-term concern. We saw it yesterday. Volatility to the upside doesn't necessarily hurt as much as it does on the downside, but the second or the best day we've had in 2 years in the market with up over 1,500%. So pretty dramatic results as a result of that 1,500 points. But we'd expect kind of the volatility in the markets to stay, through the new administration coming into place, understanding cabinet and policies, and kind of knee-jerk reactions to some of those announcements. But on the long and short of it, whatever party's in power really doesn't have an impact on where markets are headed. And kind of every leadership regime, we've had a positive S&P outcome. So no impact, no recommended changes from a portfolio perspective to try to get ahead of the results of the election, but probably a little bit more volatility over the next few months. Returns on the whole, very positive. Fixed income, what I mentioned, rates came down as a result of that Fed. We got actually all the result of core bonds here in the third quarter, up 5.2%, brought us up into positive territory, 4.4% year to date. High yields actually have been a little bit better because of the shorter duration profile and incremental yield pickup in that space. Investors have still kind of had that spread trade on, which has been positive. The equity side have been really robust, double digits across the board. U.S. large cap continues to be the primary driver for the year, but you can see it was actually the worst performing sector on this chart anyway. Still up 6%, but trailing small cap foreign markets and emerging markets for the quarter. The market continues to be very top heavy, with large technology stocks, representing the top 10 represent about 30% of the market cap. So that number is as high as it's ever been, and doesn't show any signs of stopping here with some of the recent earnings numbers that have come out. So keeping a close eye on that, not making any portfolio changes as a result of that. We do have a pretty meaningful allocation to the cap weighted S&P index in the portfolio because we think it's a place that's just very efficient and very challenging for active managers to create value. And then lastly, on the alternative side, real estate rebounded quickly. REITs are very correlated to interest rate changes and just broader equity conditions, up 16% for the quarter. More traditional real assets, buoyed as well. Commodities were driven by precious metals. And on the hedge fund side or marketable alternative side, on a more attractive public market opportunity set means more attractive returns for hedge fund managers as well. And that was certainly the case. Any questions on the markets?
Not much to complain about.
Oh, not much to complain about, although potential implications on a go-forward basis.
Yeah.
Valuations are pretty stretched here in the U.S. You may have seen we're working on our capital market assumptions, which we'll go over at our next meeting, and kind of the implications around portfolio construction. But Goldman came out with their estimate of 3.5% for U.S. equities over the next 10 years annualized. Bank of America actually came out at just shy of 3% for the cap weighted index, but 6% for an equal weighted index. So essentially saying that, the rest of the market besides the top 10 names doesn't look quite as overvalued, which is certainly the case. And valuations playing a big role in those longer term numbers. As the portfolio sits today, pretty robust portfolio growth, just shy of 35 million in the long-term pool, basically right on top of target allocations, a result of some of those recent cash flows, being able to rebalance the portfolio. Looking at returns, up about 6.4% for the quarter, 11.5 year to date, just shy of 14 fiscal year to date, and 22 on a trailing 12-month basis. So pretty attractive absolute returns for the portfolio. a little bit behind. We are a little bit behind on a relative basis on the 1 year. The same theme that Matt has touched on at previous meetings, being a little bit overweight small cap has been the biggest driver of that. And actually both the small cap managers in a kind of an environment where small cap hasn't been overly attractive, their styles haven't been overly attractive either. So both continue to be unmaintained and have no concerns with them, but they have been a little bit of a performance headwind. Fixed income has been pretty attractive. We've done kind of a lot to diversify away from just core fixed income in a rising rate environment. But Baird has performed very well. BlackRock Strategic Income has performed very well. And then the dedicated allocations to high yield and non-dollar have been very positive. So that's been accretive. I mentioned about 300 basis points behind on the domestic equity allocation, still up 32.3% on a trailing 12-month basis. So just remarkable returns generated there. Hotchkiss and Wiley and Conestoga, trailing on top of small cap trailing as well. Conestoga did bounce back pretty nicely in the quarter. They take a pretty high quality approach to small cap growth. They actually won't invest in companies that aren't profitable, and a decent sized proportion of the small cap growth index are actually kind of companies that are pre-profit. So it kind of eliminates a lot of their opportunity set with things like biotech and some of the other software and AI related names in that space. But again, no major concern. And actually, since we've owned them back to 2021, they've annualized 200 ahead of what the index has. So continue to think positively on them. On the international side, since we've kind of shifted over and implemented GQG and ARGA, both strong absolute returns. GQG has been a little bit behind benchmark, whereas MFS and Dodge and Cox have been ahead. And then on the real asset piece, we saw Cohen kind of rebound very nicely alongside what the broader REIT platform has done. Principal on that real asset piece, and then Ironwood on the hedge fund of fund side, a little bit behind the broader hedge fund of fund peer group. They take a little bit less risk than most of their peers, and notably ahead over longer term periods. So I'll pause there in the long-term pool. I did want to dig in on Ironwood in a potential change we have for the portfolio from that perspective. But let me pause first and see if there's any questions or concerns.
Any concerns on the peer rankings with the small cap managers? I mean, I understand the performance versus the market, but just versus their peers.
Yeah, I mean, some of the peers, if you look out longer term, Lori, both continue to be top quartile, top decile managers. I think we just have them both in periods where the 1 year number is eating into the 3 and 5 year and looks particularly soft on a peer group bank basis. But so Conestoga for the quarter up in the top decile again. So we're not overly concerned. I mean, that's obviously part of something that we evaluate when we're kind of re-underwriting everyone, but I think more indicative of their styles being a little bit out of favor relative to some of their other groups in their other firms in their peer group than any structural issues.
Okay.
Okay. One thing, and I know Matt foreshadowed this a little bit, Lori, with you and with John. We've been working behind the scenes to essentially create our own marketable alternative fund of funds for our clients, only open to our clients, with the rationale being that for most of our direct or in larger nonprofit clients, we're building direct hedge fund portfolios with very similar objectives to Ironwood, but gives us a little bit more control over the underlying exposures. More importantly, it allows us to strip out that additional layer of fees that are inherent with a fund of fund structure. So some of the benefits, right, for smaller portfolios is you get access to names, you get broad diversification, you get a single reporting entity versus 10 to 15 individual line items. The negative being that comes with a fee. For Ironwood, it's 95 basis points. So it's taken us a little bit of time to kind of do it and get the structure set up and get everything right. But we are up and running, and we have been since April of this year with our own commingled solution in that space that we've called Hyde Park. It has a very set return, risk, diversification objective. It allocates to actually many of the same managers that are in Ironwood, but quite a few different ones as well. I think, but the key context being that we're able to give access to our clients with no fund-to-fund management fee. So there's no additional fee beyond the advisory fee you already pay us for the work that we're doing to get access to the vehicle. So, essentially it allows us to keep the exposure, hopefully enhance the exposure, and, strip out, call it $25,000 in fees, that goes directly back to the college on a go-forward basis. So, we designed this specifically for our discretionary, OSEO nonprofit clients. It's only available to them. So kind of we're having the conversations with clients, and our expectation is to move clients over into this structure when we have liquidity with Ironwood. It depends a little bit right when those dates are, but sometime during the course of this year. But certainly didn't want to do that and just show up at a meeting saying, oh, here's this new strategy. And oh, by the way, it's proprietary to Fiduciant, without having the conversation and answer any questions or concerns that come along the way. So I know Matt sent some of this stuff over. I'm happy to walk through it or answer any questions, but I did just want to kind of outline that would generally be our expectation. But if you had any major concerns or said, listen, we just want to stay the course, we can continue to facilitate that if that's, what the desire is.
Mike,
Yeah.
what is the,
Oh, go ahead.
sorry, go ahead, Lori.
No, go ahead, Tony.
What's the, maybe you said it, but how much lower is the fee compared to Ironwood?
So Ironwood charges you 95 basis point management fee, Tony. So that 95 basis points would go away entirely.
Entirely. Got it.
So the administrative costs of Ironwood in Hyde Park are the same. Right now they're 25 basis points. So, that's kind of all the stuff that's borne by the fund. You never see it. What goes away is the 95 basis points management fee. There's no incremental economic benefit to us. The managers don't pay us to be in the strategy. The general partner who does all the kind of TPA work and whatnot, doesn't pay us. It's purely designed to offer a kind of an access structure to our clients, to the managers that we're picking for our larger direct clients in general. And again, hopefully, add some value by eliminating that extra management fee.
Are the liquidity and lockup provisions similar to Ironwood?
It's similar. So maybe so right now, Ironwood is semi-annual liquidity after a 1-year soft lock. We do have a 1-year soft lock on this fund just because it's not meant to be kind of churn regularly, and we're allocating money to managers, right, that we can't get liquidity out of, especially in the early days. So that part exists. And then it's quarterly liquidity. For the time being, it's a 25% investor level gate, which means that if you were to terminate our relationship, we would still manage this piece on your behalf. Essentially, you would get a quarter of it back each quarter. So it would take a year to get full liquidity out of it. We hope to eliminate that provision once the fund gets up to size and we can manage cash flows effectively. But because we're, essentially it was created in April. I think we have 6 clients in it right now that represent about $100 million in assets. As we get more clients and more assets, and that will be able to facilitate kind of the ins and outs a little bit better. But, right now we're still at some of the initial lock points with the underlying managers. And again, once those goes away, we'll be able to kind of pass that on as well. So 1-year soft lock in quarterly in 25% investor level gate are the terms of this. So not very different than what you have, but there is a little bit of an additional illiquidity component by just going through the transition.
So the underlying manager fees, though, are those consistent with what we're paying now?
Yeah, consistent and maybe even a little bit lower, Lori. The other thing that is probably the most notable difference is Ironwood of late has increased their exposure to some of the kind of multi-manager platform style investments that are out there, which inherently have, higher fees. Just given the structure, the pass-through structure that they have. So we have a little bit of exposure to a couple of managers that would kind of categorize in that space. Hudson Bay being one of them, Balyasny being the other, but not to the same extent. So I would actually say the look-through fees are actually probably a little bit cheaper than they are at Ironwood. In terms of, are we going from a fund that's kind of downside focused, whatever its objective is, to a fund that's a long short oriented strategy? The answer to that is no. Very similar kind of beta profiles, diversification profiles, return profiles. So we're targeting equity like returns with bond like volatility, 0.2 beta or less to equity markets. And very limited correlation of the underlying managers to traditional markets and to themselves, and actively kind of track that on a quantitative basis. It's a pretty nice basket of it's probably North American based, but we'll have a little bit of foreign exposure in there as well. You'll see that we have a pretty big slug in credit oriented strategies, but it's a combination of event-driven, credit, distressed, relative value, global macro, long, short, kind of all the primary food groups, but definitely leans a little bit more credit-oriented, especially, today where rates are, given the diversification profile. And then, we have an active track record on that strategy since April, but just to kind of give clients a little bit of context about all right, how you trust us on the kind of long only piece, but what's the team that's doing the market alternative work? This is our composite for all of our discretionary clients that have a dedicated a direct hedge fund piece, and what the return and kind of risk statistics have. So really overall time periods, we've been able to trend well ahead of what the broader fund of funds peer group has put up, with a little bit less volatility in some of the other better statistics as well. So high confidence in the team, 6 dedicated individuals on our marketable alternatives team. We have a separate operational due diligence person that operates independently of the investment team that reviews all the underlying managers as well. So I think the infrastructure that's there to drive a strategy like this.
Can I
So-
just, have just a question around maybe simplification? So why do we need hedge funds in the portfolio? So, sort of separate from Ironwood versus Hyde Park, why is the money better put into hedge fund versus just the rest of the portfolio based on our allocation strategy?
Sure. I think a fair question. So first and foremost, you don't need to have hedge funds, not a rule. It is, if you think of hedge funds on the whole, and I push not to think of it as an asset class, because it's really just a legal structure. You can have very different strategies by each hedge fund managers doing very different things. But ultimately what they're trying to do is create an investment strategy that's much more focused on absolute return and generating absolute returns regardless of what equity markets are doing or what fixed income markets are doing. So in a period like this year, trailing 12 months, when the S&P is up over 30%, it's not overly, exciting to look at hedge funds and the role that they play in portfolios, that kind of diversification, downside protection, et cetera. But in a period like 2022, or in a period where we see very challenged equity market environments, or even flat equity market environments, if they can generate, a positive return, that's in an environment where you're not getting it from the other asset classes in your portfolio, given their unique investment strategies. It's another way to continue to kind of build value and compound returns over time. So that's the role it plays, Andrea. It's much more diversification, non-correlation, a return stream that's kind of independent of what a lot of the other rest of the portfolio is doing. But you could, in theory, replicate the same risk profile just using equity and hedge funds. I would say for the same level of risk, if you do some of our modeling, you can get a higher return expectation by owning equity, hedge funds, fixed income, than just owning equity and fixed income for that same level of risk.
Right, thank you.
So, it sounds like it's an inflection point, right? Because you have this we're through the lockup of the Ironwood fund. We have this new fund getting us into another lockup. Does it make sense to kind of step back and look at the asset allocation and kind of run a couple portfolios just to see, understand what we're doing and proper sizing? Or is that something that you've done with this group before?
So we do it, Lori. So we have, and we can do it, and actually the timing works well. We do it. The fourth quarter for that governance work is when we update capital market assumptions, kind of run all the modeling, and make sure that the strategy still aligns with the objectives. Either if the objectives change, let's discuss it and build any adjustments, and if not, let's make sure everything remains in line. So we'll have all that modeling out for this quarter, for next quarter, to have that conversation. We can certainly do it. I would tell you that, at first take, right, with equity market returns down, expectations down, the models are going to show that, hedge funds potentially play an even more important role in the portfolios going forward. But we can certainly, there's nothing that says we have to make this decision or implement this tomorrow. And if we want to kind of push it off and have that conversation and kind of revalidate, hedge funds in general, the portfolio is a lot bigger today than it has been historically. Is 10% the right number? Is it 5? Is it 15? A whole host of things. We could certainly do that at that fourth quarter meeting, which would be, January, I guess, early February timeframe.
Okay. I think that would make sense. It would definitely bring me up to speed with what you're thinking as far as the allocations go, and the role. And I agree, it's grown in size, and I think there's additional assets to be allocated to the long-term fund as well, right, Andrea? So it's probably a good time to talk about it.
Okay. So we will we'll make sure we build that in, and maybe be a little bit more pointed on some of the modeling around the hedge fund piece, or the market alternative piece in particular.
Okay.
I will actually, let me pause there. Any other questions on the long-term pool before we flip over to the short-term pool? Okay. Short-term pool, ending market value of just shy of 15 million through September. Results here continue to be pretty attractive as well. On a 1-year basis, up 6.5% versus 6.3 for the benchmark, up 6% fiscal year to date. So we're starting to get kind of a lot of return here in the short term, eating into what had been pretty muted returns, just a result of the interest rate environment we had been stuck in for quite some time. No big changes to the portfolio. Again, kind of right in line with targets. That's the result of one of those contributions, that Matt mapped out for you, right? That came into the short-term pool, and then we dollar cost average from the short-term to the long-term. So that's the key driver of why these things are kind of right on top of their target allocations. But all the funds, trending right in line with where we would expect it to, and no big change from a duration standpoint. We've continued to keep it kind of tilted toward the very front end of the curve. We have, over time, been more overweight certain areas, more underweight certain areas, but 90% of this is in the half a year or less portion of the yield curve, which continues to be above the belly and long end of the yield curve. So something to keep an eye on, as this rate environment continues to shift around, but I think well positioned for where we are today. Any questions on that piece?
Nope.
Okay, well, that was everything I had prepared for our report, Lori.
Okay, thank you.
Lori, really
So-
just a summary note. Mike, appreciate it as always. Again, just really thrilled with the comprehensiveness, right? And what you see in Trustee Martin, right, is a wonderful level of fluency and understanding. I think, Lori, this is as good an opportunity, Mike, when we look ahead to the change in administration come January, that really looking, Lori, at the investment policy. We've got as clear an ability, Mike, with Lori in this role to revise as needed as we've ever had. I mean, Max starts the admirable work all these years as well, but any preparation conversations for you and Lori, now early 2025, I just think it's a good window for us to continue to just really be thoughtful. We've never had as much underinvestment as a college as we've had now. And so just, I think your term would always be, how do we wring as much value from that in as conscientious a way? I just wanted to, have a framing both for our team internally here, Lori, and knowing that we've got this line of sight with Fiducian.
So I think, I don't see the agenda, but I do think we have new business. If maybe John wants to, we're ready for that. I'm gonna ask John to jump in.
Yeah, no, I'd be glad to. So as Trustee Martin made reference to earlier, we are in a position where we can transfer another $9 million over to Fiducian. So currently we have about $18 million in our local funds. And as we just wrapped up our audit, as we're into, well into a new academic and new fiscal year, this is usually the opportunity. We take this opportunity to kind of review our cash position and our needs. And we're able to transfer $9 million over to investments at Fiducian. After looking at what the current allocation is between our long-term and short-term accounts, we currently have, as you kind of just showed, almost $15 million in our short-term account. As we've been talking right along, we will have a need of about 11.5 million for our ships relocation. So I believe, we're well positioned with our short-term portfolio. So with the $9 million, the thought is that we could invest this into the long-term portfolio. But again, would be interested in using that dollar cost averaging approach that we typically take. Part of the question would be, how long do we spread that over? Historically, when we would send maybe $4 million, $5 million down, we might kind of spread it over, $1 million a month. But this being $9 million, that's something that we'd look to you, Mike, to see if you would have a recommendation as to, how we might, get that into the long-term account.
Yeah, well, first off, congratulations, because that's
awesome.
pretty
Yeah.
good. Yeah, especially, in some of the operating stories we've heard from other higher ed institutions. So that's great. I think I saw your note, John. I was in an email, so sorry I didn't get your phone call.
No problem.
I think following that same kind of trend makes sense. I do think probably there's no need to kind of pick $1 million and say we're going to do this 9 times. I think kind of breaking it up into 2 or 3 chunks is prudent. So probably $3 million chunks makes sense. One probably as soon as it comes in the door, the next one out a quarter, then the last one a quarter after that. That'll get us through likely some of the short-term noise around the election and transition of power and everything, and then kind of into middle, or I guess early next year. So I think that's how we've kind of generally done things historically. To your point, I think it's worked well, for that size dollar amount, right? That's essentially 20% of the pool. We don't want to get it in there and then have some geopolitical event happen overnight. And so I think 3 chunks over kind of a couple quarters is continues to be a prudent way to do it. And obviously, if we set that tone and there needs to be a reason to expedite that or delay it, I mean, there's nothing that's set in stone that says we can't do that.
It's great.
Yep.
Lori, that makes sense. Obviously, it comports with our investment policy, but just as a barometer, right? That stands to reason.
Yeah, I think that makes good sense. Yep.
Great.
3 tranches, over the different quarters. Who knows what's going to happen next year? Any other new business, Andrea or John?
Nope.
Okay. So our next meeting is February 6th at 4:30. And I guess a motion to adjourn. Oh, that's just me, sorry.
Lori Martin, you're it.
So,
Thank you.
okay, thank you.
Thanks, everyone. Have a great night.
You
Appreciate it.
too. Thank you.
Take care.